Hi everybody, this is AJ speaking. This is my latest deep dive on Apple. First, we will be reviewing Apple's latest financial performance, but also look at long-term trends. We will compare Apple to popular peers, the so-called Magnificent Seven. Then we dive into forecasting, talk about the key assumptions, compare how the presented forecast compares to the current consensus. And then we talk about valuation levels, price target and share price corridor indicating buy or sell levels. I will make widely available on YouTube the financial review, the comparison with peers, but will only release the forecast and the valuation section after a long time delay, probably something like 6 months. With that out of the way, let's dive right in. I think a good starting point is to review Apple's share price performance compared to other Magnificent Six stocks, which comprise Nvidia, Microsoft, Amazon, Google, aka Alphabet, and Meta. This first slide shows you the performance of these stocks over the last 1 month. Apple came in second, returning 6.5%. Only Google did better over that period and significantly outperformed the S&P 500. Apple even outperformed over the last month's Nvidia, which came in at plus 3.6%. But of course, the last month is super short term, so we need to zoom out a bit more. This chart shows you the last 3 months, and here the picture starts to change already. Apple is up 6.6%, although this is quite good. Apple came in only number 4 among the 6 Magnificent Six. And you can also see that the market, S&P 500, was quite strong during this period, up almost 12%. But 6 months is also too short to get a little bit of background on Apple. We need to zoom out even more. Now we look at the last 6 months. And now we start slowly seeing what's going on with Apple. Apple is actually down 7.8% over the last 6 months, while all of the Mag 6 were significantly up over the time period, with perhaps the exception of Amazon, which was only up 7.1%, while the S&P 500 was up 7.9%. In other words, Apple's underperformance versus the market was over 15%. So that already tells us something must be going on. But let's zoom out even more. When we look at the year to date, so from the beginning of this year, the underperformance is even worse. We are now at just over 18%. So the underperformance is always measured as the stock's performance relative to the index, and Apple's performance was negative 9%, while the index delivered plus 9.1%. That gives us a total underperformance of 18.1%. So clearly, 2025 thus far was not Apple's year. Next, we look at it from the last year's perspective. Apple was basically flat, up 0.4%, while the S&P 500 was up 15.3%. Over this time period, all of the other Mag 6 significantly outperformed Apple. What about the last 2 years? Last 2 years, similar picture. Apple significantly underperforming the S&P 500, which was up 47%. Apple was only up 27.5%. Over the last 2 years, is what you're looking at now. We need to kind of cut the axis because Nvidia's enormous performance makes this chart very hard to read, but also Meta, a significant outlier over the last 3 years. So this next chart shows you also the last 3 years, but we cut the axis at 100% upside. And you can see over the last 3 years, Apple only did 34%, while the S&P 500 did 55%, and all of the other Mag 6 were up significantly more. Even Amazon, which is the second least performing Mag 6, did almost twice as much as Apple in terms of share price appreciation. Then the last 5 years, here again, we need to cut out Nvidia because Nvidia breaks the scale. After we did this, you can see more clearly what's going on with the other companies. And you can see that even over the last 5 years, Apple did not even match the S&P 500. Apple is up quite significantly, 82.5%, but this was during a period where the S&P performed exceptionally well, was up almost 88%. But please note, the massive underperformer, or the least performing stock amongst the Mag 6 over the last 5 years was not Apple, was in fact Amazon, up only 36%. So congrats to Jeff Bezos. He apparently timed his Amazon stock selling quite well if he invested in the other Mag 6. So the key takeaway from all this is that Apple's share price performance was quite lackluster over the last 5 years, as evidenced by the fact that Apple did not even beat the S&P 500, which is a dramatic change compared to prior years. But now let's look at the numbers. So on this first slide, we look at total revenue over the last 4 years. And in this presentation, I'm using a slightly more advanced way to chart the quarters. The latest quarter is the second quarter of 2025, and I'm referring to calendarical quarters and not fiscal year quarters, because Apple's fiscal year ends in the third quarter of the year, ending in September. And that's why there's a shift in the nomenclature Apple uses. But to reduce confusion, I will always refer to calendarical quarters. And the advanced charting I'm talking about is taking the latest quarter and going back 4 months to always, 4 quarters to always create the last 12 months or the last 12 months prior to the last 12 months. In other words, last 12 months is LTM, and the prior last 12 months before the latest last 12 months is LTM minus 1, and so on, LTM minus 2, LTM minus 3. This allows us to look at the last 4 quarter totals and compare with the prior 4 quarters total and look at the implied growth rate. And this is particularly important when you look at companies that have very strong seasonality like Apple does. And you can clearly see this when you look at this chart you have in the fourth quarter of the year. Again, calendarical quarter ending in December, you have always super strong seasonality. Fourth quarter is always by far Apple's best quarter. This is significantly driven by the Christmas business. People buy for their spouses, children, etc., family members, Apple products, iPhones, AirPods, Macs, etc. And this also coincides with Apple's latest iPhone launch. In shipments that typically start around October. So what are the key observations? First of all, the latest quarter, second quarter of this year, just announced a few weeks back. Apple's revenue was up year over year. Shows you the first percent line, or I should say the percent line with the underscore, was up 10% year over year, so that's quite strong. And you can also see that's been the strongest year-over-year revenue growth rate in a long time. You have to go back all the way to the fourth quarter of 2021 to see a double-digit year-on-year growth rate for a quarter. And when you look at the last 12 months growth rates, the most recent last 12 months period was 6% year-over-year, but the prior last 12 months growth rate was only 0.4%, which means accounting for inflation, Apple actually lost revenue in real terms, and the same thing happened in the prior last 12 months where revenue decreased by 0.9%. And we have to go back 3 years until we see significant year-on-year revenue growth. But before we dive deeper, let's bring everyone on the same page and talk real quick how Apple actually generates revenue. So there are 2 large streams of revenue. One is product related and the other one is services related. The stream that relates to products comprises mostly iPhone sales, Mac sales, iPad sales, and also variables and various other products for home like Apple TV. And this is, I think, what most people think first about when they think Apple. But then there's the large services stream, which comprises advertising, Apple Care, cloud services, digital content, and payment services. I will not read through all the details on this page, so if you like to know more about each, please pause here and look at the description. Before we move on and look in detail into Apple's revenue, let's just have a quick look how Apple compares in terms of revenue to other Mag 6 companies. This is what you see on this slide, and you can see Apple is the number 2 largest revenue generator after Amazon. And over the last 12 months to June 2025, Apple brought in $409 billion revenue. But how does revenue growth compare? And you can see here on this chart, Apple is the laggard. No Mag 6 has a slower revenue growth rate, even though, as you just saw, the most recent last 12 months growth rate was actually the strongest in 3 years. Despite this recent growth rate, Apple is still the slowest grower amongst the Mag 6. So now let's look at one of the 2 main revenue streams, so product sales. Again, this is iPhone, Mac, iPad, and wearables, home accessories, etc. This segment, this one of the 2 main segments, was up 8% year over year, up 3.8% year over year on an LTM basis. So you can already see that this was actually the weaker of the 2 main revenue streams. And then also when you look at this, you can see that in the prior 12 months and before that, year-on-year growth rates were negative. And you can see that over the last 12 months from the current perspective, Apple is still below the revenue generated with products 3 years ago. Current LTM is at 303 billion, and 3 years ago it was at 310 billion. But now let's look at services, and services is where it gets interesting. Very different picture. So services were up 13% in the second quarter year over year, and that implies that this main segment grew for 8 consecutive quarters or 2 years, double digit. And you can see this here at these underscored growth rates. So now this next chart compares both main revenue streams, products and services, and you can see, so first of all, the green line is product, and you can see the massive seasonality that Apple has. That's why you have this zigzag pattern. Q2 is always the weakest, Q4 is always the strongest. And then when you compare services, it's basically continuously going up and has virtually no seasonality. Next, we look at these revenue streams on a relative basis. So this chart now shows you each in terms of percent revenue contribution. So products contributed in the second quarter 70.8% of total revenue, and services contributed the remainder 29.2%. And you can see products continued to lose importance. They're still by far the primary revenue generator, of course, at more than twice the size of services, but products tends to shrink, or shrink is the wrong word, is losing relative importance as the services segment just keeps growing much faster. The interesting thing here is that it's quite comparable with Amazon, where we see a similar picture. So if you haven't watched my ultra deep dive into Amazon, I highly recommend you watch that one after this one. Let's keep going. So this next chart breaks down product revenue into its subcomponents. These are iPhone sales, Mac sales, iPad sales, and then the bucket wearables, home and accessories. They're all shown in a solid line, and services shown as a dashed line. Services is not subdivided further because Apple does not disclose that, although that would be super interesting. So on this slide, so what are the key observations? First of all, iPhone dominates product sales, clearly contributing 45 billion. The second largest products revenue stream is Macs, contributing 8 billion. And then the other buckets, iPad and then the wearables, home and accessories bucket, they each contribute 7 billion. So key observation, everything else pales in comparison to iPhone sales. So iPhone remains still extremely important to Apple. And the other key observation is that these other product segments, Mac, iPad, wearables, home, accessories, have seen for several years a flat or even a slightly downward trend. For example, if you look at Q2 2022, wearables brought in 8 billion, this quarter only 7 billion. iPad brought in 7, this quarter also 7 billion, so flat. So again, on an inflation adjusted basis, down. And then you have Mac sales up slightly from 7 to 8 billion. So in other words, none of these other product segments grow meaningfully to offset anything bad that could happen to iPhone sales. I think the average consumer who might not look at Apple's numbers might assume, because Apple is selling all these other products, you might think in aggregate they might also kind of at least sell as much as iPhone, but the reality is very different. So when you add up these other buckets, 7, 7, and 8, that only gets you to 22 billion, which is not even half of iPhone sales. But the reality is that bringing in like 7 billion or 8 billion in Mac sales, 7 billion on iPad, and with these other gadgets, another 7 billion. These would be for pretty much every other company very successful businesses, but because the iPhone is so ultra successful and therefore so large, it makes these other businesses still look like underperforming, even though they are not. So Apple got here really kind of a luxury problem, but it doesn't help at Apple's valuation. So here this next analysis looks at it in terms of percent contribution, and this makes this even more clear. iPhone contributes 47% to Apple's total revenue, and during the peak Christmas season, fourth quarter, it was even in last fourth quarter 55.6%. And then please note, earlier I said services have hardly any seasonality. The reason why you see now this seasonality in the percent is not because there's seasonality, but because the iPhone has such massive seasonality and has such revenue bumps, it skews the percent number, i.e. it pulls it down in the services segment. It's just so this is clear for everyone. But then when you look at the other product segments, you can see none of them gets even to 10% contribution. And let's go really quick through different products. So iPhone was up 13% in the second quarter. So that's very positive. And iPhone over the last 12 months is up 4%. But keep in mind, this is barely above the rate of inflation. So in other words, iPhone's still not recovering in real terms. I shared recently analysis widely on X, which demonstrated a peak iPhone revenue actually was in 2021. So that's 4 years ago. And since then, Apple was unable to actually get back to that level. And currently we are roughly 15% below peak in real terms. So what about Macs? Macs were up quite nicely, 15% in the quarter and up almost 10% over the last 12 months. But here again, this comes after 2 really bad years that were down 12% and 10%. iPad was down in the second quarter 8%, but last 12 months up 7%. And here too, this comes after a long underperformance. It's partially still an effect of COVID. Everybody got an iPad during COVID lockdowns, etc. And that created kind of a iPad bubble. And then afterwards, we had weakening demand, obviously. And this is what you see here in the numbers. Then we look at wearables, home, and accessories. This segment is down 9% year over year. Last 12 months is down 4.2%, and the last 3 years have been down year over year. And if this was inflation adjusted, these numbers would be looking even worse. So this product segment is really not performing, or I should say, is not really contributing to the company's growth at all. Then we look at the important services segment, and here you can see this is the highlight. But we looked at this before, so we move right on. Let's talk about money. So we get now to gross profit. So gross profit is after you paid for delivering a good or service, but this is before operating expenses, which include R&D expenses and SG&A expenses. So in the most recent quarter, Apple brought in 43.7 billion in gross profit. That number is up 10% year over year. In the last 12 months, Apple brought in 191 billion in gross profit, and that is up 7.6%. Also positively, the prior 12 months were also up year over year at 6.2%. But again, if you inflation adjusted, it would look quite lackluster. So what about margins? So this is what this chart shows you, gross margin. And I will change the scale a bit so to make it a bit clearer to see. So gross margin has been improving, and the most recent quarter came in at 46.5%, which is a good number, and is up year on year 23 basis points. So 23 basis points is 0.23% points. And the current last 12 months are up 72 basis points to 46.7%, and that's the best last 12 months period in several years. So the profitability picture looks good. So what about operating profits is what you see on this chart. So operating profit is a gross profit less R&D expenses, less SG&A expenses. And in the most recent quarter, Apple generated 28.2 billion. That's up 11% year over year, and the last 12 months is up 8% to 130 billion. So the business remains quite high performing. And I think this becomes even more evident when you compare Apple's operating income generation with that of the other Mag 6. At 130 billion in operating income generation over the last 12 months, Apple ranks number 1 amongst the Mag 6, even a tiny bit before or ahead of Microsoft, but it's very close. Microsoft is at 129 billion. And if you calculate a simple market value divided by last 12 months operating income multiple, Apple would be somewhere in the middle at 25.9 times. Alphabet, aka Google, and Meta would be lower at 20.8 times and 24.0 times respectively. But this is just illustratively for investing purposes. I highly discourage using trailing multiples. Investing should always be valuation driven, and valuation is always forward looking. But this is something I will be covering in a separate video where I will be comparing the Mag 6 and certain other companies on a forward looking basis. But this too will be only a video for subscribers. So we just established on operating income, Apple looks quite good, but there is one big problem. And that big problem you can see on this chart. When it comes to operating income growth, Apple looks actually quite bad, coming in last in this group of companies at only 8%, and everyone else grew at least at double that rate. So you can see that it's not only revenue growth, but also operating income growth that is a big problem for Apple. But then obviously big picture, the problem is how do you actually move 130 billion operating income needle? You really have to find a killer product to make a dent in that income number, I mean positively. Now let's look at it in terms of margins. Second quarter margin came in at exactly 30%. That is up 43 basis points year over year, and the last 12 months are up 59 basis points to 31.9%. So now let's see why operating income is not growing that much. The first driver we already established, there's not that much revenue growth, but then there's another problem. Operating expenses. Here, this is what this chart shows you. Operating expenses were up 8% year over year to 15.5 billion. Last 12 months, operating expenses were up 6.9% to 60.5 billion. And this is actually really bad news. But to see this more clearly, we need to turn this into a margin. And this is what you see on this slide. So this slide shows you total operating expenses divided by total revenue. And you can see that in the second quarter, Apple spent 16.5% of total revenue on operating expenses. This is only marginally down 20 basis points year over year, but the last 12 months are up 12 basis points to 14.8%. And the key observation in this chart is actually when you look down here at the last 4 years, you look at the totals, and you can see that 4 years ago, Apple only spent 12.8% on operating expenses, and then this number increased every year. And this basically is quite revealing in terms of what's going on. One, Apple is struggling with growth. We already know this. Margin is okay, gross margin specifically. But Apple has to spend more and more in terms of R&D and SG&A to actually generate the revenue. So Apple is becoming less efficient. I mean, in business school, you always get taught, there are economies of scale. As the business gets larger, there's a larger gross profit base over which you can distribute the operating expenses, and this is driving outsized earnings growth. None of that is true. Take that BS and throw it out of the window. I can't see this literally in none of the companies, large companies, ultra large companies I cover. Only in smaller companies you do see this, but then later as they become super large, and there's disruption happening like AI, then all this goes out of the window, and they invest as much as they can to win that race to not become a Kodak. Kodak, for the few amongst you who don't know, Kodak is a famous case study in the business world because Kodak dominated totally its market globally, which was the film market. And to add, and they obviously they lost all their market, but to add insult to injury, they did have the disrupting technology, digital photography, and were too, stupid to see the future of photography. And everyone at these large companies knows this case study, and none of them wants to become another Kodak. And that's why they're investing right now like hell to win in the AI race. And we do also see this in Apple, and we can clearly see this in these numbers effectively. But the number that shows it most clearly is R&D expenses, and this is what you look at right now. And R&D expenses were up 11% year over year in the second quarter to 8.87 billion. This makes Apple one of the top R&D spenders globally. And over the last 12 months, R&D spend was up 8.2% to 33.4 billion. But again, let's turn this into a margin that is more meaningful, and this is what this chart shows you. You can see how R&D margin jumped to a all-time high of 9.43%. In other words, Apple spent on every dollar of revenue in the second quarter 9.43 cents or 9.43% away in R&D. And when you look down here at the 12 months figures, you can see for the last couple of years, every year that percent increased. So 4 years ago, that percent was at 6.5%, was already a year-over-year increase, 43 basis points. Then it accelerated, moved up to 7.65%, was 113 basis point increase year over year, then moved to just over 8%, another increase of 37 basis points. And then this year we I should say over the last 12 months, we're at almost 18.2%. So you can clearly see in these numbers, Apple is throwing more money at R&D. Whether this will be enough, we have to see. But let's move on. Here, the picture also not looking great. You look at dollar amounts. So Apple spent in the second quarter 6.65 billion on SG&A. It's up 5%, and the last 12 months are up 5.3% to 27.1 billion. But let's turn this into a margin again, so you can see that. And again, please pay attention down here to the full year numbers. You can see in the 3 years leading up to the most recent 1 year period, SG&A expenses continuously increased, and only in the last 12 months they reduced a tiny bit by 5 basis points. 5 basis points is a reduction of 0.05 percentage points. In other words, Apple became over the last couple of years less efficient. So now we covered almost all the important items, and we're almost at earnings. This next chart shows you non-operating items which are not needle movers for Apple, so we move right on. I just show this for completeness. This is profit before tax, but this is also something I will be skipping because we go right to shareholders' net income, so earnings after tax. This is what this slide shows you. So shareholders' net income came in at 23.4 billion in the second quarter, up 9% year over year, and the last 12 months were down 2.6% to 99.3 billion. And now we are slowly getting close to valuation, and there are a couple of technical aspects we need to pay attention to. So the number you're looking at is a GAAP number, but for valuation purposes, we need to use an adjusted number. And this chart shows you the difference between an adjusted net income number and the just looked at shareholders' net income number. The primary difference is the add back of share-based compensation. I will skip why you have to do this for technical reasons. I explained this many times before in other videos. So let's move on. This next chart then compares the net income power of the Max 6. And here, no surprise, Apple comes out on top, generating 118 billion of adjusted net income, and also gives it a multiple somewhere in the middle of the field at 28.5 times. But again, this is just for comparison. This is not valuation, which should be forward-looking. Then also net income grows 8%, makes Apple again the slowest grower. But this is hiding something really important about Apple, and which I believe will actually be the story of Apple in the next couple of quarters. But before we get there, let's just look at a simple regression. And for the mathematicians amongst the listeners, yes, I know I don't have nearly enough data points to run a regression, a meaningful one, but this is just a high-level introduction to the valuation topic and kind of a accessible comparison of these companies. So just please bear with me, I should pronounce. Apple looks on that metric slightly expensive, mostly due to lack of growth, and has a slightly elevated multiple. Simplistically, when you look at this kind of chart, what you can say is everyone above the line is a little expensive or very expensive, depending on how far is away, and everyone below the line is cheap. But again, this is not based on forward-looking multiples, so do not take this as valuation analysis. This is just on historicals and current market cap to have no dispute about outlook, anything like that. And of course, these companies are not peers in a classical valuation sense. Peers in a classical valuation sense are companies that sell similar products in the same industry and or have very similar economic drivers if you have a lack of true industry peers. But let's move on. Now we look at the number of shares. So that is a very important point in Apple's case. The number of shares have been reducing quite significantly, and you can see this on these year-on-year change numbers. So the share count reduced by 3% in the second quarter, and this has been a long-term trend. Over the last 12 months, share count reduced by 2.6%. And the reason why share count has reduced so much is what you see on this chart. This chart plots Apple's quarterly share buybacks. And in the most recent quarter, Apple bought stock back worth $21 billion. But worth noting, this was the lowest level of share buyback in 6 quarters. And when we look at this next slide, we can look at it a bit more analytically. This shows you the change. So the share buyback in the most recent quarter was down 21% year over year. And this year's share buyback, or I should say the last 12 months share buyback, is still, however, ahead 5.3%. Over the last 12 months, Apple bought back 95.7 billion in stock, which is an all-time high over the trailing 12 months from the second quarter perspective. And now we get to earnings per share. The number you're looking at is a GAAP metric. That's what Apple reports. Please note the third quarter of 2024, where you see this significant drop to 97 cents. That was driven by a very large one-off item. And this is also another reason why you should always use adjusted EPS for any kind of valuation work, because adjusted EPS adjusts for these one-off items. That large one-off item was a over 10 billion tax payment Apple had to do in the European Union. But for valuation, these one-time items you always need to subtract or cancel out. But this chart shows you reported GAAP earnings, so that's why I did not adjust for it. But this chart already gives you a clue what's going on in Apple, because when you look at the second quarter earnings per share is actually up 12%. That is a pretty good EPS growth number. But this is where I will end this public part of this Apple deep dive. I need to be fair to my subscribers, and therefore I have to retain certain high value research pieces for them. So if you haven't already subscribed to my account on X, I highly recommend you do so. It's very easy to do so. It's very cheap. In my view, it's a total no-brainer if you invest in stocks. Thank you very much for listening. Hope this was helpful. See you next one. Bye.